trading at its best.
So for those of you, if this is your first time to the webinar, I'm Mike Swanson, and we've taught a lot of different subjects over the last few months, and I've been trading for almost a decade now. And so you're going to learn some things that you might not see others do. You might have already came to a few of these webinars and or watched the replays and have seen that, you know, I've got a lot of proprietary things, and I've been trading the markets full time for that full 10 years or 9 years. It's about 9.5. So I've learned a lot over the years, and today we're only going to have time to share 2 trailing stop techniques. That's what the plans are today, but we will go into some examples on the charts of using them with different types of strategies, as well as answering some questions. I know we had this topic, or this as a suggestion really last week in last week's webinar, is a few of you were asking about how to use trailing stops with the methods I've been teaching, with such as the simple trading strategy that we taught a few weeks ago. So we'll be going into that today, showing you how to apply it to your strategy. We're going to go over the 2 techniques that are completely different, but one might work better for you than another. It will really just depend on your, just had to fix that little typo there. It'll just depend on your style of trading. If you need a lot of room on your trades because you're holding them long term, you know, you might use the first method that I'm going to show you. But we'll go over all of that and explain how this all works on some chart examples that I'll bring up. We'll definitely go over many examples so you walk away from this able to apply it. Okay, so everybody ready? I'm going to go ahead and bring some charts up now, and we're going to dive right into this. Just a quick note, for those of you that may have to leave early or you want to review the webinars and these trainings, we record it. We record all of these, and we post them on our YouTube channel, and we also send out an email, and we have a place on our website where we put all of the past replays. So at the end of the webinar, I'll probably post that link so you guys can get access to the past trainings that we've done, and you'll be able to see where this one's going to go as well. Okay, so let's see here. Make sure these charts come up for you guys. Okay, here we go. So we're just going to have some bare charts to start off with. And the first technique that I'm going to teach you here is using the ATR, which stands for Average True Range. You'll see the indicator in most trading platforms. In MetaTrader, it's just right here under Indicators, Average True Range. And we taught this technique as a way of determining your initial stop in the simple trading strategy training that I did. So it's going to be a little bit familiar, but we're going to show you how to apply it as a trailing stop now. So we'll attach this indicator to our chart, and we're going to set it to the 14 period. And by default, that's usually going to be what you see when you attach yours. If you've never used it before, it'll be 14. Okay? And you can always refer back to the blog. We've got a summary of these things we're going over today, and that's just at the TradeWestForex.com/blog. Okay, so I'll put that on my chart, and that'll appear at the bottom. And the readout that you're seeing here is pips. It's in decimal format, but it's actually just like your price up here. If it's 4 digits over or 5 digits, whatever it is, when it moves up 1 point, that's a pip. So what we're going to be doing is we can go over here and grab this little data window, and that will allow us to see the value. You can hover over it as well, as you can see, but it's much quicker just to scroll along here. When you're on a candle, you can see it. So it says ATR is 11 pips right there, 12 pips, 13, then it went up to 16. You can see it's adjusting based on the volatility of the market. So the reason this trailing stop works well is because, for that reason, it adjusts for a volatility in the market. So when the markets get tight, you see that the ATR is smaller and smaller, down to 12, 11 pips. It starts to expand, and those numbers increase. goes back up to 15, 16 pips. So that way it's self-adapting in a way. It's adjusting to the volatility in the market, which is what you want when you're using a trailing stop. You don't want to be too close and you don't want to be too far away. Okay, so once you have this indicator on your chart, now all you're going to do is you can either use the value or you might use 2 ATRs or 3 ATRs, which simply means you multiply this. So current bar, 16 pips. That would mean is if I'm in a trade, once I'm up 16 pips, I want my trailing stop to activate, and I'll put it 16 pips away from the price. And as the price moves further into profit, I'm always going to stay 16 pips away. Now what I can do is on the next bar, what we're going to have to do, let's just scroll back. Okay, we need to go ahead and do an example to make put this all together and make sense. Oops, I have to turn off auto scroll. Okay, so let's say you bought right here and you're trying to decide when to activate a trailing stop. You don't know where the market's going yet and you're basically at break even. Well, we would look at our ATR at that point and see 12 pips. So what we would do then is say, okay, I'm only going to move my trailing stop once I'm up 12 pips in profit. And you'll see 1 ATR is going to be pretty conservative. And this is like I say, you might need to times that by 2 or 3. But that's all you'd really need to do. It's pretty simple. And that's something you're going to do some visual back testing on to determine that. And we'll do a little bit of that now or here as we do a few of these examples. So we'd say, okay, 12 pips, I want to see 12 pips profit. So we could put a line on our chart, have an alert go off, whatever we want to do here. That's going to be, I drew it pretty much right on. So 12 pips is right there. So now we're not going to do anything until the price hits that point. Okay, right here we hit 12 pips. So now what we're going to do is we're going to move our trailing stop. At that point it goes to break even, right? Because that's 12 pips away. Okay. Now that's just the simple approach. I'm going to show you how you're going to need to adapt this as price moves and as that ATR changes. See, at first here it was 12. Let's back up. Hopefully I don't lose you guys here. Okay, so at first it was 12 pips on that bar. But then the second bar it was 10. So you're going to have to adjust that line down a bit and say, okay, now I only have to wait 10 pips. Well, I can see it didn't go there, so I'm not going to do that. The next bar says 9, so it's getting closer. We could move this down a few pips. And here we're still at 9. Okay, and then this bar kicks in and hits it. So see, it was 9 instead of 12. It's it's adapting here where you've got to adjust as the price moves along. Now, it was only a few pips, so you might not, if you don't want to be, you don't have to be ultra perfect with this approach. You could have very well left it at 12, and that's fine. This is just giving you an idea how much volatility there is in the markets so that you don't put your stops too close or too far away. So now that it's activated at 9 pips, I've moved my stop to break even, and then every pip that it moves up, I move my trailing stop up 1 pip. Okay, so if it moved up here, it looks like it did go 2 pips, so my trailing stop's going to go up to 2 pips as well. Okay, then the next bar comes along and it went all the way up here. Okay, so now what we can do is look at our ATR on that previous bar. It was 9 pips still. So I'm going to go 9 pips from the price. That's going to put me at 30. And I probably would have got taken out right there. Okay, so like I say, that 1 ATR, or just looking at this ATR indicator value, is really tight and conservative. If you go 2 ATRs, then you'd be out another 9 pips, so you'd be down here at 21, and you'd still be in that trade. So we're going to show you how to do some of this visual testing to determine what's best for your strategy, because everybody's is going to be different. Some of you might be fine with that 9 pip trailing stop right there. You'd have been out with actually about 9 pips. That's what it ended up being on that one, 9 or 10 pips. And that might have been fine for your strategy. Maybe you're scalping and trying to just get the short-term little swing. Others might want to catch the bigger moves. So that's where you'll need the times it by 2 or 3 ATRs. Is this making sense so far? I'm sure that at first it's going to seem confusing, and once I make a few examples and we walk through this one bar at a time like we're doing, it'll come together and make sense. Okay, so let's just look at it if you were in 2 ATRs. So now you'd be down here at 21. Next bar comes up. Now it's still 9 pips, hasn't changed. Okay, so we don't go anywhere. We're only looking as it makes a higher high or hits it. So in this case, it would have hit. So 1 ATR would have made you more money. 2 ATRs, you would have broke even or got a pip on that. 3 ATRs, you wouldn't have even kicked it in yet. Let's see, actually you'd be at 9, you'd be at 27 before you kick it in. So yeah, it would have needed to get to 48, and the price didn't get there yet. So you'd still be holding on. And then here you would have finally kicked it in, because there's 48. Okay, so now you would have moved it to break even. Then as it moved up, you are going to be 11 pips away. You just look at the previous bar on the ATR. It's 11 pips. So you're 11 pips away from the high there, which puts you at 73. And the next bar did not hit it, continues to move up. Now you're going to go to previous bar was 16 pips, so 16 pips off that high is 91, and it looks like it probably would have hit you on that one on the way back down. So you see 3 ATRs in this case. If you're waiting it out and holding out for a bigger move, 3 ATRs would have been best. You would have been able to capture a 71 pip profit with the 3 ATR method. But like I say, some of you would have been fine right here. Oops. Accidentally zoomed out and lost where we're at. There we go. Okay, some of you would have been fine getting out right here on that pullback at break even or with 1 ATRs at 9 pips, because you would have possibly got back in. You're maybe trading more short term and just trying to get in and out. So there's no one particular answer for everybody. How did I get the data window to show? Okay, what you do is it's right on your toolbar menu, this little target aiming little icon. And if you don't see that toolbar, then you can go up here to View Toolbars, and I think it might be Charts. Nope, it's not Charts. Let's see, View. We turn on or turn off one of mine. Standard. Okay, so you just need the standard toolbar. Go to View Toolbars. Standard. If that's turned on, you should see the little data window icon right there. Okay, so let's go and do a few more examples here. Hal made a good point. You'd better make sure that you look at this ahead of time. Go test it with your strategy and see what's going to work best for you. Just like I'm showing you here, 1 ATR, 2 ATR, 3 ATR give you completely different results, and one might apply to one person and the other might apply to a different person. Okay, so let's back up. We'll just do some more examples. As you can see, just like with everything I've been teaching lately, is I like to do this without the benefit of hindsight. So that way it's just like the live environment, right? I mean, we don't get the real ticks in the market. So, I mean, there is some differences here, but still it's better than just going back and looking at an example that's already finished. And the way I'm doing that is I'm just going up here and turning off auto scroll, and then I am just scrolling back and then using the F12 button to look at the market one bar at a time. Okay, so let's do another example. Let's say, let's go right here and say you were trying to buy that bottom, and so you bought right here on the way back up. Okay, so the first thing you do is look at the previous bar. It's 9 pips. Okay, maybe we're looking for a big reversal here, so we're going to go with 3 ATRs. So I'm going to times that by 3, 27 pips. So that means it needs to go up 27 pips into profit. So I'll just look at my current entry, would be about 31.22. I add 27 pips. It puts me at 31.49. I'm just going to put a marker there so we can kind of see where that's at. So I'm not going to do anything until the price gets here. Now, when the next bar comes up, the ATR is going to change. So I'm going to change this line. And like I said, you don't have to do that, but that's going to help you adapt to the market conditions, the volatility in the market. So nothing happened there. I'll hit the next bar. Okay, now we got some momentum. Let's look at the previous bar. It's 11 pips. So it went from 9 to 11, right? So I need to adjust my trailing stop. Okay, so it hit that, so I'm going to need to be 11 pips away. Now I can't see how this bar ticked. Okay, so this might have jumped up and 11, we're going to do 11 times 3, so 33 pips. Let's just make sure it even got there first of all. So that would have been about right here. You would have been up 33 pips, and then you can put it 33 pips away from price. So let's just assume that it didn't pull back 33 pips anywhere on that bar, which it might have, it might not have. Okay, so the high was 79. We're going to take 33 pips off that high. So that's 46 would be our stop loss. The first line that I draw is just to tell you that's when you take action. Okay, which basically means you're moving it to break even. And then as it moves up, you're going to move the trailing stop up based on the previous bar's ATR times 3 in this case, 33. So the high was 31.79. I'm going to move it down to 46. Okay, so you don't just, this is not how it looks in real time. Like I say, we don't get to see the bar movement, but I'll try to simulate what might have happened here and see if you guys can follow along. But obviously in this case, it did come down really fast, and you would have got trailed out before it came all the way down here, right? So you would have made the 33 pips. But let me show you what would have been happening here more in real time. Okay, when this first kicked in, we were looking, it needed to get up 33 pips, up to 44. Okay, so we just said, okay, as soon as it gets to that point, I'm moving to break even, and then every pip that it moves up, I'm going to move it by 1 pip. Okay, so it got to here. Okay, now that meant our, oops, keep moving the line. Okay, so now that it's moved there, we're going to move our trailing stop to here, our stop loss, right? Our stop loss was below price at first. Now we're going to move it to this point. Maybe what I'll do to make this less confusing is I will make this a different color than the line we're using for just a signal reference point. Okay, so that's your actual stop loss. Let's say your stop loss started off down here, and we said, okay, at this point, we know we want it to get to 44 before we're going to do anything. All we did there was we took the entry at 31.21 and added 3 ATRs, which you can see over there was 11 pips times 3, 33. So that's roughly about 31.44. So I'm just putting a line there as for reference. So I'm going to change the color of that so nobody gets confused. Okay, so we're just using this blue line as a reference, saying once it gets to this point, start using the trailing stop. Because there's 2 parts to this. You have to know when to start using it, and then by how far away from price you're going to trail. So once we get there, we're saying we're going to move our stop to break even once it reaches that point, that price. This will be a little bit better example now that we can have these 2 lines. So once the price got there, this is what we did. We moved our stop to break even. Now, when this price moved up a pip, we moved our stop loss up a pip. When it moved up another pip, we moved up it again, right? And so on, all the way up. So as this price moved up and up and up and up, all the way up to that top, we continued moving this up 33 pips away from price. That's all it ends up being at the end of all this. It's always 33 pips behind, 3 ATRs. So 33 pips off that high was about 46. So that's where you stopped moving it. Okay, so once the price stops going up, then as it comes down, you're just seeing if it's going to hit your trailing stop. And sure enough, it did right there, and that's what makes you the profit with the trailing stop. Am I confusing anybody? Is this all pretty clear? I know I kind of jumped around and approached it a couple different ways, but I think this is the most clear example. Everything clear? Bob says he's clear. Carr says, do you move the TL trailing stop dynamically or on the closed candle? That's up to you on that. It can definitely be, if you don't have something doing it for you, it can be a real pain to watch intra-bar. And if that's a problem for you and you don't have a tool that allows you to type in a trailing stop, then you'd have to, you'd probably want to do the on close. Okay. Now, if you're trading daily charts, then it's not really as big of a deal to just look at the previous bar, set it up in a tool to do it. I know our PipStat tool has this functionality. You can go in and specify when to activate and how far away, and then it would automatically watch it intra-bar for you. Just go over the last candle and setting the ATR. Yeah, so we'll do a few more examples now that we've got everybody start to see the picture. But do you only move at the close of the candle? Again, that's something that you have to decide if you want to watch the bar or not. If you want to watch the bar develop, then you would want to use in real time, like I was demonstrating here. If you waited for the close, in this case, it would have been too late, right? Because by the time you moved your stop, the price was sitting right here, and that you would have missed the opportunity. I mean, this is a rare candle to see a very fast pullback like that, and that's why sometimes it is better to watch intra-bar. But that's where I would use something like PipStat, and you just type in, let me go bring it up real quick. You would just type in the trailing stop pips, and then let it automatically do it for you intra-bar, and you don't have to wait for the close in that case. So give me 1 minute, I'll bring up PipStat here. Let's see. Okay, I think I did it. Actually, I already have it running. Give me 1 more minute here. Okay, so I'll just bring up PipStat. I just applied it to one of my charts. Okay, so you don't have to put the PipStat tool, as you know, those of you that have PipStat, you don't have to put it on every chart. You just put it on one chart, and then it comes up and runs in the background on its own. Okay, so here we go. So here's what PipStat would do, how it could help you with trailing stop, is what you would do before you even knew, you do it at the open of the bar. Okay, so before you even knew where price was going to go, you would look at the previous bar. We saw on the data window, we saw that the previous bar was 11 pips ATR. We're times it by 3 in this case, so 33 pips. And then all we're going to do is go into our settings, click Use Trailing Stop, and we're going to set it to activate at 33 pips, and we also want it to trail it by 33 pips. And we don't want to use this move once, because that means just move it to break even and that's it. Okay, so what this is going to do is exactly what I showed you here. It's going to follow price. As soon as it reaches 33 pips of profit, it's going to move it to break even, 33 pips away. When it moves to 34 pips of profit, the trailing stop will be 1 pip of profit. Does that make sense? It's always going to be 33 pips away from price. So in this case, like I showed you, it would have followed it all the way up to 79. On the way up, it would have just kept modifying it. And then once it hit 79, 33 pips away is 46 is where it would have stopped moving. And it would have been doing that during that bar on the movement that we can't see now. So while it was moving up, it came back down and would have taken you out. And that's what PipStat does automatically. But if you don't have a tool like this, then you're going to have to either watch it and do it manually, or you could do it on the close of the bar, make the decisions, and then just look at the, just look at it once per bar. Okay, let me make sure I've answered your couple questions from everyone, and then I'll move on and do a few examples with this approach, and then I'm going to teach you the other trailing stop method. Just want to make sure everybody's got the hang of this one. Okay, Hal was saying that you want to make sure your broker lets you do 30 pips or 5 pips or whatever you end up with, because they can limit you where you can't modify your stop loss. There's some brokerages that require a minimum distance, sometimes a pretty high distance. You'll see for me, it says my stop or take profit must differ by at least 1 pip. So it's not a big deal for me, but some brokers do restrict that to 10 pips, 30 pips, and you need to check that first. Okay. So let's see, a couple more questions to answer here. What I'm saying, okay. Please repeat how you calculate the ATR. Okay, Rob, we'll go over that in just a minute. I'm going to do a few more examples and we'll explain it over again. How can you get PipStat? Let me post a link for you guys. We have a trial. You can give it a shot and see if it has a lot of other things that we're not going to really talk about today, but the trailing stop is very helpful for what we're teaching today. So I'll post the link. Give me 1 second here and I'll grab that. I think we have it in our blog somewhere, but I'll just post the link directly as well. Okay, so there's the link to that. I'll just show you guys that page. I just posted the link in the chat. It's just tradewestforex.com/pipstat/pipstat.php. I think you can even go to just promos/pipstat. I don't think you have to add the rest of that. Let me just make sure. Yeah. So just tradewestforex.com/promos/pipstat. I've posted that in the chat. And that's where you can get you can download a trial of PipStat for 30 days. Okay. Moving on, let's go back and do a few examples of this method, a few more before we move on to the next method. Okay, so let's back up here. I'm just going to move these lines out of the way so we don't have any confusion there. Okay, let's do an example if you're selling. Okay, so let's say you decide the market's moving along, you decide to sell right here. Or for some reason, maybe you get in a little bit earlier. Oops. Let's go with that. You sell right here, expecting a breakout down. Market takes off. You need to know, okay, where do I, before we move on that bar, you're trying to decide when you should use your trailing stop and what numbers to put into PipStat, for example. So you're going to look at the previous bar, and you'll see that it's 12 is the ATR. The way we got the ATR is we went over here to Indicators, we went to Average True Range, we double-clicked on it, and we put in 14 periods and hit OK. And that puts this blue line down here, which we're not paying a whole lot of attention to that. We're just using it to get this number in our little data window. Okay, so our data window on the previous bar, when we took our trade, it showed 12 pips. Now we have to decide how many ATRs we're going to use, which you'll determine that from some of this testing and just adapting it to find what, how conservative or aggressive you want to be with it. The lower the number, the more conservative you're being, meaning that you're just trying to get out and be safe. And the higher means the more room you're going to give your trade for larger moves and giving the market more room to breathe. So in this case, let's say we just go with 2 ATRs this time. So we're taking that 12 pips that you see over here in the data window, okay, on the previous bar, 12 pips. That's what that 0.0012 is, 12 pips. Now I'm just going to times that by 2 in this case, so 24 pips. So what that means, as soon as the price is the market is 24 pips into profit on my trade, I will then move my my stop loss from wherever it's at, say it's up here somewhere like it is, I would move it to break even in that case. So that's the first step. 24 pips I need. So let's see how much 24 pips would be. It's a little bit more out than where we're at. Needs to go up somewhere in here. Let's see. I entered at 36, so it needs to go down to 12. So right about where I drew it. Okay. Shouldn't have moved it. There we go. So we're not going to do anything until it reaches that price. Okay, so it didn't do it on the first bar. Now, before we got here on the next bar, we're going to look at the previous bar again. It moved to 13, so I might need to adjust my trailing stop just a little bit, 2 pips. 13 times 2 is 26. The previous bar we were at 24, so I need to give it 2 more pips of room. So that'd be about 10, which it did barely reach it. So we reached the value where we would move our stop to break even. Okay? So now that we're at break even, we're going to watch price as it continues to move down. We're going to move, we're going to always keep our stop 26 pips in this case on this current bar here, 26 pips away from price. Or you just move it as the market moves down a pip, you move your stop loss down a pip. Okay, so the next bar, as this bar was moving down, we're moving our stop just like that. Bar moved down some more. I'm just kind of simulating what happened in real time here. The market was moving around, but as it moves down, we were moving our stop loss proportionally so that we were always 26 pips still again, 13 times 2. You just look at that previous bar. So 26 pips away from price. So to speed ahead here, I'll show you how it ended up. It got down to the bottom at 83, and we're adding 26 pips. That puts us at 09. So at the end of that bar, oops, let's make sure we don't jump ahead. At the end of that bar, we are at 09 on our stop loss. Okay? So see, our entry was up here where that arrow is at. So far we've locked in about 24 pips of profit. Okay, and if the market comes back and hits it, then we've reduced risk because we'd be taken out for a profit and not be giving it back. Okay, so next bar, it goes lower, so we need to adjust it. Okay, we look at the previous ATR, it's 15. So now we're going to want to be 30 pips away from price. Okay, so that means we're sitting here at let's move this line down. The price got down to 72. So plus 30 is going to be 02. So we're moving about right there, and that's where it came up and hit. Pretty simple, right? Price came down, hits our trailing stop, we're out right there for a profit, and we can go back and measure it now. We ended up making about 33 pips. Okay, so let's see if 2 ATRs worked out and got us the most out of that trade. Okay. It would have went up, up, almost to break even. Market pulls back, kind of flattens out, and eventually comes up some more. So it looks like that was a good place. We got most of the move with that trailing stop approach with 2 ATRs. Okay, so that's all that you do is you need to just go test this with your strategy. You might find it got you out too soon or too late. Then you need to adjust the ATRs. And you just have to find the sweet spot with your particular strategy. So that's the idea, John, with why we use sometimes 2 or 3 ATRs or just 1. Is it depends on what you're trying to do. If you're just trying to, let's just use the past market here to demonstrate this. Okay, let's say you've got a strategy where your goal is to do something like this. You're trying to buy here, and then you want to get that swing before it goes out, turns back. So you're trying to get out somewhere in this bar. And then you're going to maybe buy again when it takes off here. So you're going to use a lower ATR if you're trying to just squeeze the most out of these short-term little moves here. because maybe, like as you can see here, your plan is to get back in and do the same thing. Try to squeeze as much out of that you can out of that move. Maybe you get it out right there. So that's going to require a lower ATR multiplier. But if you're a trader that just wants to take one trade and you're trying to catch a larger swing, and you're looking for a higher, better risk to reward ratio, because your stop might be larger. Your stop might be out here, so you want to get a larger move. If that's the case, then you're going to need to give it more room with the ATRs so that you can withstand this pullback, which ended up being that was 31 pips, or if we look at the data window, at that point that would have been about a 2 ATRs. It almost went 2 ATRs. It went just 1 pip shy of 2 ATRs. So 2 would have been close here. You might have wanted 3 ATRs just to be safe. Okay, so then when it gets up to the top here, you're sitting 63 pips away. Okay, so let's just look here. Your entry was 35. The top went up here to 51, 34, 51. So at that point, you'd be looking at, if 3 ATRs would have been 61 pips, you'd be at 90. You subtracted that off at the top. So there's where your stop would have been at this point, right there. You would have already locked in some profit. Giving it more room to breathe, you would have made it through that little pullback, and then you just keep adjusting it. See, here it would have changed. Okay? Because you were 63 pips here, then you would have needed a little bit more room, about 6 more pips. So you would have had to adjust it down, about right in there. And then the next bar stayed the same. Looks like that one was the same as well. Same value, so it didn't change till right here. Now you can give it a little bit less room, go up about 3 pips. And see what it's going to do, it's going to tighten up closer and closer as the market contracts and volatility changes. So here you're another 3 pips. Now you're up to about 92. Okay, so the easy way to do this is just look at your ATR, times it by 3, and that's how many pips you need to be from the market. Okay, now here's the thing. I think I might have made a mistake a second ago. I moved it down. Okay, the rule is you don't ever move it down. You always are moving it up. Okay, so if you make the calculation here and it's 60 pips or something, you don't go move your stop back down. I want to make sure that we make that clear, that I didn't confuse anyone there. I'm always moving it up. Okay, so let's back up. Let's make sure that everybody's following this here, okay? So at this point, right here, somewhere on this candle is when we moved it to break even, I think. Let's just walk through this example one more time so it's completely clear. Okay, we bought here. We look at the previous candle. At that time, it was only 10 pips. So times that by 3, 30 pips of profit you needed. Our entry was at 35, so you needed to see price get to about 65. Okay, once it hit there, you're moving let's make sure we use our other line. Once you hit that point at 65, which was 30 pips of profit, 3 ATRs, then we move to break even. Okay, next bar comes up. Now it's saying we need to be 12, so times that by 3, 36 pips away from the price. Okay, so the high went up to 99, so 36 puts you at 63. So it didn't need to change. It was right about where we're at. Remember, if it's bigger, if it's further away, do not move. You don't want to move your stop lower, but we can move it up. Okay, so we said 36 off this high puts you at 63. Okay. That's based on the high of that bar, 36 pips. So now you're right here. Okay, next bar, now you're 14 times 3 is 42. So you take the high. 42 puts you at 64. So this goes up a little bit. Okay. Next bar, I can see here it's not going to be moved because price is not going up, so we're just going to keep moving along. Okay, now the price went higher. Now we're going to move it, Let's look at the previous bar, 17 times 3, which is 51. So the high here was 37. So that puts us at about 86. So we're going to move it up to 86. If this is all confusing, I know PipStat's going to make it a lot easier, because all you're going to have to do there is just look at your ATR, times it by 3, and then type in the numbers in PipStat, and that's it. But I want you guys to understand it and see how it works, and have this all make sense. Oops, I moved over. So we're right here. We moved it. Bar was up at this high. So we were right there. We had it moved 51 pips away. Okay, so that's about 86. Okay, so we're right here now. Next bar. Now it says 21. So that's 63 pips away from this high, which puts you at 90. Moved it up a little bit. Okay, now you're at, so we went from 21 to 23, so that's 69. We're closer than that, so we're not going to move it. 24, still not going to move it. I just know we don't have to move it because we're not going higher, and all these numbers aren't coming down low enough. See, I mean, for example, right here, you'd be 672 pips. So we know that we're much closer than 72. We do not want to move it down. Yeah, Jerry, this is being recorded, so it's okay if you're late. We're just going over this trailing stop method, and in just a few minutes we're going to go into the second method. This one is based on ATR. Okay, so we'll do a few more examples with this, and then we're going to move on. So let's just keep following this trade along and see where it finally ends up. Okay, so 18, that's still, right now, see, we're only 28 pips away, so 3 ATRs, none of these are going to change anything. So we'll keep moving. Okay, right here, now it's tightening up. Now we're down to 30. 3 ATRs here is 30, so we're going to move it up just a little bit. Okay, then we're at 9, so 27 off of this high. Okay, we're sitting about, right, just a few more pips up. Okay, now we're at 8, so 24 off of this high. And that's about where we're at. Next one, still 24, 24. Okay, then it hits. So there you go. That's how that one would have played out with 3 ATRs. It would have went all the way to the end right there, which gave you a good chunk of that move with just the trailing stop. And you probably would have scaled out somewhere in here and made even more, but I wanted you to see if you strictly used a trailing stop, this is how that one would have played out. Okay, let me back up, make sure that everybody's questions has been answered. And I think we might have done enough examples. I might do one more if everybody's still not quite clear before we move on to the next method. Is PipStat adaptive to the change of ATR? This is, like I say, you don't have to change it on every ATR value. PipStat is not an ATR, it's not ATR based. You enter the value. That's why you know, it works with different styles where you're not using the ATR, you might be using just a fixed pip amount. Or you just want it to move to break even. It's more flexible than just ATR, so that's why how that works. So I guess the simple answer is it does not look at the ATR and change it for you. But it's still fine if you're just periodically checking in and seeing, okay, it's contracted now, let's go modify PipStat to 6, you know, over here you finally would have had to change it to 24 pips from originally like 33 or whatever it was. So you just be checking on it once per bar and make the changes. Okay, so is everybody clear on this technique? Or is there anybody that wants me to do one more example? So in the blog, we usually give a summary of the things we talk about in the webinar, but I don't think it's as detailed. The blogs are much more simplified. So if you're going to want to review this, you probably want to watch the replay and you can just take a few notes. Yeah, PipStat would move the trailing stop for you. PipStat would automatically do everything, as far as waiting for the price to hit that level and then moving it for you and continuously moving it as the price moved higher and higher. So this added idea of continuously watching the ATR as it tightens up is that's something you can do add on separately. You don't have to do that. It just squeezes out a little bit more out of the market when it contracts. Let me just give you an idea here. If we did not change, let's just say we used PipStat and walked away, okay? We would have ended up right here saying it was 10 pips, so 30 pips away from price. We would have left it at 30 pips at all times. Okay, so in that case, you would have gotten out 30 pips from the high, which would have put you at 20. 34.20. So you would have gotten out, actually in this case, better. It would have got you out right there because it would not have adapted to this volatility. Other times, though, it might have been worse. It just all depends. But that would have been the set and forget approach. You would have been right here, and you would have said, okay, I'm going to use PipStat. I've already got my trade in. Your stop was down here, and you would have said, okay, PipStat says, ATR says use 10 pips, times that by 3. So it would have said, okay, I'm going to kick in at 30 pips profit and move it by 30 pips at all times. So you would have set that in PipStat and walked away. PipStat would have moved it up to break even when you were 30 pips in profit. And then for every pip it moved up beyond that, as this is moving up, it would have continuously moved up and followed price until it eventually hit the top at 51, and then it would have moved you to 21. So right here, oops. So right there it'd say, okay, you're at 51, let's move you to 21, and you would have got taken out right there, pretty close to the top. Okay, so John says if I can do one more example, no problem. Let's back up and find another example. Now I've been doing this all on the hourly euro, but don't pay much attention to this time frame and pair. It can work on anything, any pair and time frame. I can go up over here to the daily. It's just the pip numbers are going to change. Now we have a bigger pip amount. So let's just do an example here. Okay. Let's see. Let's watch this move right here. Let's say you got into this counter trend reversal of the uptrend and you went short. Okay, so you put your stop up here, and let's say your entry was, let's say you were a little bit late and you didn't get in till right here on this bar. Okay, so you're in right here and you've got a stop. It doesn't really matter where it's at, but let's just say your stop's up here, and now you're trying to figure out at what point should you put a trailing stop in, or what number should you put into PipStat. Okay, well, look at the previous bar. It's 102. And I'm going to say we're looking for a larger move here on this one. We're going to go with the 3 ATRs. So we're not just trying to get a little scalp or trying to pick the initial swing or pullback. So let's go with 3 ATRs. It would be 306 pips on the daily chart. So that'd be 413. Oops, I went the wrong way. So 106 or 306. We're going to take that, the price we're entered at, 3107. This is the manual way of doing it, right? Of course, with PipStat, all you're going to do is enter 306 into both those fields on PipStat, and then hit OK, and it's done. It'll take over. But I want to show you guys how to do it manually again. So 306. You're going to see your price is entry is at 3107. So 306 is about 1.2806. So you're not going to move it till you get down here to 2806. Okay, so you see that's pretty aggressive, that you're waiting quite a bit before you're going to move. Like I say, you might go with 2, you might go with 1 ATR, but let's see. Let me just make sure. Okay, it's going to hit that. I didn't want to waste our time and go through it and have it not hit. Okay. Okay, so of course you have the option of changing it, right? Too. The next bar comes along. Now it's only 87. So now you could tighten it up quite a bit to about 268 pips. So that's about 30 pips closer. Oops. So let's just do that. You can move it up to about 30 pips closer. That's where that ended up being, right there. Okay, so now you only have to get to here. It adjusts again. Now, it's only adjusting a few pips. I'm not going to mess with it, but 92, 89 is about the same, 91, 83 is a little bit closer. 82 is 246. Okay, so 246 from our entry. That's a little bit better. We only have to get about right here at 2862. Okay, somewhere right in here. Not going to be perfectly accurate, but okay. Next bar, it would widen it a little bit if you're adjusting it. Okay, here you're maybe a little bit wider. Okay, at that point, see, your 93 pips times 3, 279 pips from your entry is about 224 or 2824. So I had to go a little bit more. Okay, so right there you hit it. Now you've hit the point where you're going to kick the trailing stop in. So that means you're moving to break even. You're moving it to 200. You're looking at that 96 times 3. Okay, so about 288 pips. 288 pips away from your from the current price. Okay, so let's see what the current price at break even. It's going to be break even at first, right? So let's just make sure we got 288 from the entry. We're at 3109. It's a little more complicated at on the daily charts with these larger numbers, but you could get your calculator out if you wanted to. I'm just trying to do it in my head. But 288 pips puts you at about 28. That'd be 28.21. Okay, so you're at 28.21 is what is the exact price you'd be looking for at that point, somewhere right in there. Okay, so now you move it to break even. Now every pip that it moves, you're going to move your trailing stop that much into profit. You're always going to keep it that 288 pips away. Okay, so if it goes down, it went down from that 21 down to a low of 5, so it went up 16 pips more at this low. So I'm going to move 16 pips into profit, about right there. Okay, next bar, didn't go any lower. ATR didn't really change a whole lot. It went down 4 pips, I guess, so that would adjust you times 3, so 12 more. Let's go down to about right there. Okay, market starts to pull up a little bit. Okay, now it goes lower. Now you're at 78 times 3. It's about 234. Okay, so 234, we can take 37.9, or from our entry, or I mean from the low, sorry. 234 is 29.87. Okay, so now we're somewhere right in here. And that's when the price is at that point on this bar. So we're locking in profit, keeps moving along. Okay, right there. See, this is why the trailing stop is so helpful. Look what happened. You already had your stop moved before this bar just jolted and shot way up. This was that day in July where the market just took a huge dive, in this case shot up 400 pips. Well, rather than being in a loss at that point, right, you would have been down right in here. Your entry was right there. You would have been losing money. Your trailing stop, it gave a lot back, but still made you, with 3 ATRs, you made 125 pips still on the trade. So it would have kicked you out right there. 2 ATRs would have got you more. It would have been tighter, but it might have got you out even too soon over here. That's what you have to kind of play with your strategy. Okay, so that's the last example we're going to do on this one. Yeah, Hal, you could use Momentics with this for an entry strategy and use this trailing stop. You could use the simple trading strategy I taught a few weeks ago. It's posted in the blog and in our webinar replay. You could use any of those with this trailing stop method. So let's go ahead and we took quite a bit of time demonstrating this technique. The other one is going to be a little bit more familiar. It's going to be a pattern-based trailing stop where you don't use pips. You look at a pattern and then move your stop to a previous low or high. Okay, so let me go ahead and show you that one now. So let's look at a, let's just go look at a place in the market where you would have taken an entry. Okay, let's go right here. Let's say you sold. You sold right there. You got your stop loss in somewhere where you would lose money, and you're wondering, when can I move at my stop to lock in profit? Okay, so the technique I'm going to show you, with a pattern you're probably familiar with, but we're going to review it and show you how to use it as a trailing stop. It would be the market structure high and market structure low. Once you see that pattern, you can move your stop to the previous high in the case of a buy trade, and you'll move it to the previous low in the case of a sell trade. Okay, so our previous high. Here, we'll just demonstrate it. Okay, so we're selling. We're going to be looking for a market structure low. Market structure low tells us the market's turning to the upside. Okay, so we're looking for a 3-bar pattern, and what it's going to look like, I'll just go show you one in the past here that's already taken place, is we're looking at 3 bars. Okay, we've got a bar right here, and then the next bar needs to have a lower low, which it did, and then the third bar needs to have a higher low. So you basically have this pattern where you have low, lower low, higher low. That's a market structure low telling us prices were going to go up. Now the confirmation and where you are going to put your stop loss that I'll show you will be at the high of that bar, of that third bar. Okay, so right there. When price breaks that, it's confirmed that price is going to head up like it did there. Okay, so now that you see that pattern, let's show you how to use it as the market moves down into our favor on this trade if it gets into profit. Okay, so we want to look at the next bar and look for this pattern. Do we see it yet? We don't see it, right? We're low, we're lower, but we don't have a higher low yet. Okay, and we want to make sure that we're in profit. See, the very first of this trade took it. It was telling us that prices were going to possibly move up, but we weren't in profit, so we couldn't really do anything. We want to wait till we're in profit. Okay, here we are, lower, lower, lower. Okay, higher low. We now have the pattern. Does everybody see that? You've got the low, a lower low, and then a higher low. 3-bar pattern. Just like over here. Once you see that, move your stop loss to the high, as long as that shows that it's profitable. Because a trailing stop really is designed here to lock in profits. So that was fine. We moved our stop loss to lock in profit at the previous, or that third bar's high. Now, one little thing I need to note here, wait for the close. That third bar with that higher low needs to close, because you don't want to have that high moving around. So when that bar closes, okay, so you're really at the open of this bar, then you're moving your stop to that point. Okay, now you can see this bar was clear, it didn't hit it, so you're still in the market. Okay, and then you can look for another one. Here's another market structure low. Okay, so I'm just going to move this along. Here's your 3 bars doing the same thing. Okay, you've got the low, lower low, higher low. When you see that, what are you going to do? You're going to wait for the close, make sure it's still formed just like that. So you're going to wait for that open of the next bar, and then you're going to move your trailing stop to that high of that third bar. Okay, now let's see if it gets hit. Okay, that was really conservative and tight, but it got you out right there. So you're out right at the bottom of this move for a profit before it turns back up, and would have been at break even, or you would have been at a loss. So you were out right there on where that line's at. Okay, so this is a very effective method as well. It's a little more conservative, or aggressive, however you want to look at it. It runs really close to the price at times. You might want to use it more for scaling out, but it is definitely a good way to lock in profits before the markets turn and get you the most out of the market. So I entered right here. Hopefully you can see this little arrow. That's where my entry was in this one. Okay, so to go over that one again, our entry was right here. We were waiting for the pattern, which didn't form until right there. And we had that the stop loss we moved to, oops. Okay, we had the stop loss at that time moved to right there. That's when we very first moved it. It was on the close of this last bar that you can see here. So on the open of that bar. Okay, and that's because we had that low, the lower low, and then a slightly higher low. And then we moved it to the high of that bar when it closed. Okay, and then we continued to watch price. And we saw that it formed another one. It went lower, lower, higher. Now that it formed that, we waited for the close and then moved our trailing stop to the high of that bar. Our entry was still right here. We had locked in about 131 pips of profit before it turned up. Okay, so this one's pretty simple. There's not a lot of math and numbers like the other method, but they're both completely separate and different from each other. So one might work better for you than the other. You have to just play around with it. Do exactly what I'm doing right now. Grab your charts, grab your strategy, go back and test it. Test it with both of these. See which ones are giving you better results. Okay, let me show you the high now, market structure high, so you can see how to use this with the buy trade. Okay, so let's say you bought right here. Okay, you bought at the top expecting a breakout. Doesn't really matter where we're entering. I just want you to see the trailing stop side of this. Okay, so you put your stop in somewhere down here maybe. Okay, that's all separate from today's webinar. Learning where to get in and where to initially put your stop, you'll have to go and review some of our past webinars and blog posts on that. And we've taught how to do that as well. Okay, so let's see. You're right here. You're waiting for, in this case, let me go draw one for you in the past. You're looking for a high, a higher high, and then a lower high. That's the market structure high pattern. Once it forms that, the signal is the low of that third bar. When it breaks that, that's where we're going to be putting our trailing stop, as you'll see in this next example here. Okay, so here we are. We're looking for a higher high, and then a lower high. The next bar does not give us a lower high. It's still higher. And we're still higher, higher. We aren't doing anything until we get a lower high. And that's why this method works really well in trends, because as the market continuously pushes higher highs, you're just sitting there riding it along and giving the market room until it finally shows weakness that it's going to turn down, which was right here. You see how it's a lower high now? Once you get that lower high, you're simply moving your trailing stop to the low of that bar. Okay. Once it closes, though, we don't want that bar moving around when we're moving our trailing stop. We want it closed and confirmed. So when it closed that bar, we moved it to the low of that third bar in the pattern. So you can see here we ended up having the high. We have a higher high. Oops. And then we had the lower high. Is that all clear? Once you see that and the bar closes, you move the trailing stop, move your stop loss to the low of that third bar. Okay, the next bar hits it, you're out. You made a profit of 80, 90 pips or so, and the market kind of bounced around, and you saved yourself from going all the way back to break even and losing money. Anybody want to see a few more examples on this one, or is this one all pretty clear? As you can see, it's much easier than the other technique, but like I say, the other one might work better for certain strategies. You know, it might get you more out of a move. You know, one of this method, let me just show you an example. Okay, this method I can see would have taken you out right here on this move. Okay, so if I back up and show that maybe you bought right here, or maybe you bought somewhere down in this, oops, you bought that candle. Let's show you how this would have worked out and show you cases where the ATR would have been better. Okay, so here it went higher, 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 lower high. You would have your stop loss right there. You've locked in profit, and it would have barely hit you, as you can see. It would have hit you and then would have taken off, where the ATR would not have done that. Okay, I can see that the ATR method in this case would have been better because at this point right here, you're sitting at 93 pips. So, you know, how many pips did it pull back? 126. So even 2 ATRs would have kept you in that move for a bigger run. Okay, so let's just go ahead and wrap it up. I'll answer a few questions, but the conclusion here is if you plan on using a trailing stop, you might want to use a combination of both. And the way you can do that is use the scaling out technique. Maybe you use the market structure high in this case to take you out, and you take out half of your trade or a quarter of your trade. You take off a few lots or many lots. Take some profit off, move the rest of your trade to break even maybe, but at least you've locked in some profit here, and then use the ATR method for the rest to ride it all the way up to the top so that when it gets up here, if you're at 2 ATRs still, you're looking at, you got out about 200 pips off the high about right here. So you had the benefit of both by using scaling out. Okay, so I think we've had a webinar on scaling out, the training on that. You can go look in our blog. Let me go ahead and let me go bring the blog up real quick, and I'll show you how you can find this stuff. Okay, so if you just go to TradeWestForex.com/blog, you'll see that here is the post from today on the 2 trailing stop methods. You can review that. There's not a ton of detail there. It just gives you a quick review. Some have more detail than others. Then you'll see the links to the webinar like the one today. And then look out in your email. We will be sending the replays. And I'm also going to post a link to our YouTube channel and webinar today so you guys can refer back to it there and watch these recordings. But what I can do is I can come in the search. I can type in, let's see, we were talking about scaling out. And I can type in scaling out, and it'll bring up some different posts where we talked about scaling out. Okay, now I'm thinking we might not have called it scaling out. Let's just try scaling. I'll probably go add that tag to the post so we can find it, but you know, maybe we didn't have one on that. Let's just see here. You can also even just go to the blog and scroll through, but the search is definitely easier. But if we haven't taught on it, then you're not going to find anything. So let me just scaling. Okay, so it was in the best. So it was finding it. It was in the broker post, and that was it. So it looks like we have not taught scaling in and scaling out. Let me just make sure. We might have that be next week's topic. Okay. Well, I think we've kind of briefly touched on it in like money management and things. That's what we've done. That's what's making me think we've taught it. So it might be a good idea next week we could have a webinar on training on scaling out and scaling in. So we'll get into some just full webinar teaching that topic next week. You guys can review the blog, and let me get you guys the link to where we post these replays. You can actually just go to TradeWestForex.com/webinar/weekly. That will show you the last replay. Okay, so if you see right here, you can see last week's session was determining trend direction. So you can go right there to TradeWestForex.com/webinar/weekly. I'll post that in the chat here. That's where you see the last week's replay, and also the blog post is all linked right there. And then if you want to get further back than just that one, when you go to watch this, okay, you'll see you'll start to see all of our other posts on here. So you can see there's Fibonacci trading, there's the simple trading strategy post, the broker, what is a VPS, you'll see them all right there. You could even just click on, if you click on Mike Swanson or the icon here, you can subscribe to our channel. You see quite a few people have subscribed already, indirectly, but you can click on there and go to the actual channel, and that's where you'll see everything from these webinars. Okay, so I think I've answered everybody's questions, and I hope everybody can go out on your charts over the weekend and practice this stuff. You don't need the markets to be open. You can use that F12 key, scroll back on your charts, and simulate all these things I've been teaching one bar at a time so it feels like the real market, and you're gonna learn a lot doing things that way, and how to apply these techniques. Go do it with your own strategies, and I know this stuff will improve your trading. As you can see, just the few examples we showed today, showed some very good exits where you were getting most of the move, but you were giving the market room to breathe. Okay, so thanks everybody for coming to the webinar today. Hope to see you in next week's session. Look out for the email where we'll have the blog post. Usually we do that on Friday mornings, and then we have the webinar in the afternoon. Okay, thanks again. Hope everybody has a great weekend.